Hello, I've returned with another ADH wealth solution. Today, we will begin to discuss fulfilling all of your financial needs. As always, this is a basic description. For an evaluation of your own, please schedule an appointment. My information is in the description. Lastly, make sure you hit the like, drop a comment, and if you're new, subscribe and hit the notification bell so you're made aware every time I release new content. Yo, it's your boy, the insurance junkie, your fiduciary fella, the all-star advisor, Alonzo Hall. And I've returned today to whap and tap on your head with another ADH wealth solution / a cash command. And this is a how-to today. So we may call this my Welcome to Financial series that I used to do with y'all. At any rate, this is how to choose a financial advisor in 6 easy steps in 2022. A December 28, 2021 article from money.com. Before we go in, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, you can contribute to channel growth by hitting the Cash App. You can schedule a one-on-one appointment with a licensed financial professional, or you can purchase life insurance directly up to $1 million with an instant decision and no medical exam. The links are in the description. So as we proceed to give you what you need. It says here, financial advisors aren't only for the very wealthy. People in all sorts of financial situations can benefit from some guidance with their financial planning. Whether you need to come up with a savings plan for retirement, manage your debt, diversify your portfolio, or make your paycheck last longer, a financial advisor can help you set clear financial goals and much more. With so many options now available, it's key that you first learn how to find a financial advisor that's right for you. Step 1, identify why you need a financial advice. Finding the right kind of financial advisor is easier after you determine why you need one. Are you early in your career and want to know how much and how to save for your financial goals? Are you paying for your child's education or navigating finances during a divorce? There's likely an advisor for your specific situation. You may need more than one kind of financial plan, and that's okay. Just make sure the financial professionals you're considering have the skills, knowledge, and experience to help you with your specific financial needs. Here's a list of financial advisors list of issues financial advisors may help you with. Retirement planning, paying down debts, investing, tax planning, budgeting and savings, getting insured, estate planning. Step 2, find the best financial advisor for you. A financial advisor is a certified expert that provides guidance on personal finances, tax laws, investments, and asset management. Some financial advisors resemble coaches. They can help you make basic financial decisions and teach you solid spending, saving, and borrowing habits. They can also perform high-level investment management for the wealthiest individuals and businesses. So, pause before we get there, especially with my black folks. An expert stunt driver and can drive at hundreds of miles an hour like a race car driver. Then and only then will I go buy a car. You wouldn't do that. Once you get your driver's license, you go buy a car. And you become an expert driver by driving that car. So you're not going to get money and then become financially savvy to go see a financial advisor. You go see a financial advisor, and that's how you become financially savvy. So now here's a summary of the main types of financial advisors out there. Investment advisors know market conditions and create investment and plan to tailor to your financial goals. You pay them a fee for their advice about whether and when to trade specific securities. It's worth noting that an investment financial advisor is purposely spelled with an E instead of an O. to specifically identify legally regulated investment professionals. An investment advisor may be registered with the SEC and a state securities regulator. The term is not interchangeable with financial advisor, which is a broader scope and generally refers to brokers, and it is not bound to a fixed legal definition. Stockbrokers buy stocks and bonds on behalf of their clients. They're usually associated with a brokerage firm and can make trades for both retail investors as well as institutional investors. Certified financial planners regulated by the CFP board help clients create long-term wealth management board plans, taking into account their entire financial life, retirement and investment goals, insurance, taxes, and more. They often work with specific types of clients like small businesses. Robo-advisors. Robo-advisors are digital investment management services that use algorithms and data about your financial goal to give you tailored suggestions about where and how much you should invest. Many advisors use a hybrid model which combines some personal interactions with robo-offerings. Robo-advisors can cost much less than a human advisor. However, some experts are critical of robo-advisors, alleging that they can't have the customized approach to risk management a human would. If you're attracted to this low-cost option, industry insiders recommend picking a hybrid model such as Schwab Intelligent Portfolios Premium or Vanguard Personal Advisor Series to combine the ease and low cost of a robo-advisor and still make decisions when you can't, like a healthcare proxy or an executor. Identify why you need a financial plan. You may need more than one kind, and that's okay. Then make sure the financial professionals you're considering have the skills, knowledge, and experience to help you. Step 3. Know how financial professionals get paid. Traditional advisors. There are various ways advisors make money, like a commission for selling products, an annual percentage of an investor's assets, or an hourly rate, so you shouldn't be afraid to ask for the details. Different payment structures might create different incentives, says securities attorney Alan Rosca. If somebody is paid only to sell investments, it means he doesn't sell you anything he doesn't make money on. Here are some ways financial advisors get compensated for their time and expertise. Hourly rate. You should pay advisors for their time like you would an attorney. Hourly rates range from $100 to $400 per hour, according to financial advice site Smart Asset. Flat or annual fee. Financial advisors could collect 1 to 2% annual percentage of your assets under management. So for instance, if your total assets total $100,000, you would have to pay between $1,000 and $2,000. Commissions. Advisors could collect commission on the financial product they sell you. Fixed rate. Advisors could charge a fixed fee between $1,000 and $3,000 for a service of creating a full financial plan. Retainer. If you have a complex financial situation, sometimes a financial advisor will work on a retainer model and charge you either monthly, quarterly, or annually. Since this is not asset-based, it can help minimize conflicts of interest and keep focus on advice. Some financial advisor fee structures combine two of these methods. An advisor could charge a flat fee while also collecting commission on sales of new products. If you need advice for a specific problem and don't plan to build a long-term relationship that includes investment management, you should choose someone with an hourly rate. Robo-advisors. Robo-advisors are worth looking into as an affordable alternative. The best robo-advisors charge as little as 0.15% in annual management fees, and some don't even have account minimums. Critics note that robo-advisors rely on the information you provide to make generalized recommendations through an algorithm, whereas traditional advisors may be able to catch nuances and make stock moves based on your specific needs. However, robo-advisors have been a great starting point for many beginning investors with more limited budgets. Step 4. Determine whether you need a fiduciary financial advisor. You might think all financial advisors will put their clients' needs first and avoid conflicts of interest, but that's not always the case. Many different financial professionals fall to reduce their own compensation. Registered investment advisors have this obligation, while critics say brokers do not, despite a recent regulation that was intended to strengthen these standards. This comes as a surprise to a lot of people. A 2019 survey from the digital wealth manager Personal Capital found that 48% of Americans mistakenly believe that all financial advisors must meet this fiduciary standard. Meeting the fiduciary standard matters most when you're hiring a financial advisor to invest and choose financial products on your behalf. If you're simply seeking help building a monthly budget, this issue is likely not as crucial. In either case, don't be shy about asking potential financial advisors whether they are fiduciaries and any other questions about how they're compensated. It's your net worth at stake, after all. Since this is a complex topic that deserves more attention, we dug a little deeper. You can read our in-depth search further down below. Step 5. Search for the financial planning help you need. Alan Roska jokes that people will travel to faraway gas stations or appliance store to find the cheapest gas dishwashers or dryers. They'll spend hours at car dealerships before buying a car, but they'll rely on a quick Google search to find the right financial advisor. We should spend the same amount of time before we give somebody our hard-earned money, he adds. While you could always use the internet to find financial advisors in your area, you have a more precise search tools available. Things like BrokerCheck. BrokerCheck is provided by FINRA, the Financial Industry Regulatory Authority. You can do some digging into someone's experience and see whether prospective advisors have faced any disciplinary actions. IAPD, the Investment Advisor Public Disclosure. The SEC's IADP website is a database that can help confirm that a registered investment advisor, be it a firm or an individual, has the certifications that they say they do. The NAPFA. The NAPFA is a professional association of fee-only financial advisors. Fee-only advisors are paid a fixed rate and don't earn commissions. You can use their Find an Advisor search tool to find fiduciaries in your neighborhood. Step 6. Meet potential advisors or brokers. Once you have identified some potential advisors that meet your requirements, start making calls and set up appointments. Whether it's knowing more about your financial advisor's credentials or a detailed explanation of their pay structure, don't be afraid to ask for what you need. After all, your life savings are at stake. Questions to ask before hiring financial advisors. Here are some questions you can ask. Who are your typical customers? How will we communicate with each other? How much will I pay, and how is that number determined? How are you compensated? Are you compensated for recommending certain products? How do you choose investments and products for your clients? If charged an annual percentage, will it be billed quarterly or monthly? Do you charge by the hour? Do you have a fiduciary duty to your customers? You should also ask questions about your specific situation. Say you're a divorced woman in your 40s. Does the advisor have other clients in the same boats? If you're a small business owner, do they have experience with that specialization? If you're just starting out in your career, have they worked with millennials or Gen Zers in the past? If an advisor doesn't want to discuss these details, move on to someone else. It's important you choose an advisor who is transparent about how they'll handle your finances and answer any questions you might have. COVID-19 and financial advisors. Before the pandemic, finance experts prioritized in-person meetings with their clients, and the bulk of counseling was still done face-to-face. But this has changed with the pandemic. Stay-at-home orders push professionals to turn to video calls in order to keep their business relationships running and help the increasing demand of clients in need of advice. Although face-to-face meetings will still be important, video calls and other forms of communication are expected to stay in place even after the return to normalcy. People looking to hire a financial advisor online will find it increasingly easier, as many agencies and self-employed professionals are adapting and growing their online presence and services. The fiduciary standard isn't always simple. The fiduciary standard, the rule stating that financial advisors must place their clients' interests before their own, isn't always as clear-cut as it sounds. Customer protection advocates have long been pushing for more strict and clear fiduciary standards across the industry, but they've been disappointed with many of the moves made to further the protection of individual investors. In 2019, the SEC implemented the new regulation Best Interests, Reg BI. The new code of conduct holds that financial advisors and broker-dealers must only recommend products that are in the customer's best interest. Clearly identify any possible conflict of interest or financial incentive the broker-dealer may have. The problem with the new regulation is the SEC didn't clearly define best interests, says James Watkins, an attorney managing a member of InvestSense. It therefore doesn't protect investors to the extent that a true fiduciary rule would. The SEC will be defined on a case-by-case basis, but the lack of clarity only serves to create unnecessary uncertainty and unnecessary risk exposure for both advisors and investors, Watkins says. How do you protect your best interests? The best way to protect yourself is to choose a financial analyst who voluntarily minimizes the conflicts of interest in their business model and voluntarily adheres to the fiduciary standard, higher than the one the SEC enforces, says Barbara Roper, Director of Investor Protection for Consumer Federation of America. Look for advisors with the CFEC certification, which audits firms and advisors and certifies them as meeting the fiduciary standard. It's also important to keep in mind that brokers may have a different pay structure than advisors. They may make money by selling you products that are okay for you, will offer them a bigger commission, but are not necessarily the best for you. Don't be shy about asking prospective advisors how they're compensated. Watkins also recommends asking whether an advisor is open architecture or closed architecture. Open architecture means that the advisor can sell anything to you. Closed architecture, conversely, means the advisor is limited in what they can sell, often because they're receiving some sort of compensation from whoever is marketing the investment, like a mutual fund manager. It may be best to actively find someone who is open architect and seek out advisory firms that are fee only or paid exclusively by the client, so you know that third-party incentives aren't involved at all. How to avoid falling victim to fraudulent practices. Scammers can easily pass themselves off as financial advisors or experts, lending an air of legitimacy to their scheme. Sue Zorman, Dave Ramsey, Wall Street Trapper. You can use some of the search tools mentioned above, such as FINRA's BrokerCheck and SEC's IADP, to see whether prospective advisors have any lawsuits or disciplinary actions filed against them and ensure they're registered with SEC and FINRA. That being said, real registered advisors can also engage in investment fraud. So even if you are meeting an advisor with a seemingly legitimate practice, you should know what practices are considered fraudulent and what signs to watch out for. A legitimate, trustworthy financial professional will fully disclose potential conflicts of interest, set realistic expectations when it comes to earnings as opposed to grand promises of consistently above average returns, give you an accurate assessment of the risk associated with each investment, and always act in your best interest. They'll usually tell you up front things like, hey, I charge a fee, I can give you a quick quote, but it's not going to be in your best interest. Steer clear of any of the following. High-pressure sales tactics. Use of phrases like once-in-a-lifetime opportunity or breakthrough technologies. Cold calls from unregistered and unsupervised salespeople claiming to be brokers. Emails from unknown senders promising a great investment opportunity. Refusal or delay in sending information about investment in writing. Advice to keep the investment opportunity confidential, or pressure to make quick decisions. Watch out for these common investment frauds. Affinity fraud. This scam exploits the trust between tight-knit communities and specific group of people: ethnic, religious, professionals, the elderly, etc. A scammer will approach and convince a trusted member to invest, who then unwittingly encourages more people from their community. The investment generally turns out to be a Ponzi scheme. Crypto. By the time people are wise to the scam, the money is long gone. Crypto. Always be skeptical of an investment opportunity and analyze it thoroughly, no matter who presents it. Churning. Your broker makes an excessive amount of selling and trading with the goal to increase their commission earnings, disregarding your best interests. Watch out for unauthorized or frequent trading and any suspiciously high amount of fees in your portfolio, as it could be a sign that your broker is defrauding you. Be especially wary of advice to buy variable annuities, as they have higher fees and are commonly pushed by brokers who want to earn higher commissions. Pause. So when you're purchasing annuities, generally if you're going to buy, and this is something that a great advisor friend of mine will tell you about, keep your insurance, and your investments. If you're going to buy an annuity or an insurance, you can buy an indexed annuity or an indexed insurance. But if you buy a variable annuity or a variable insurance, don't waste your money on those variable products. And I sell them, but don't waste your money on those variable products. Spend your money on an actual investment. That's when you should do an investment over an insurance, if you're going to go variable. Now let's continue. Promissory note fraud. Promissory notes are a legitimate form of investment. Investors lend money to a company which in turn promises a fixed return. However, promissory notes are commonly used to scam individual investors. So before investing in these types of securities, you must check out their legitimacy. A promissory note must be registered either with the SEC or the state securities regulator. You can verify a promissory note online with the SEC's EDGAR database or by calling the state securities regulator. Pump and dump. This scheme artificially raises the value of a company, pump, by spreading misinformation with the goal to demand and inflate the value of the stocks. I'll give you an example. Shiba Inu is at 0.0004. Y'all better get in this Shiba Inu before it turns to 17. And the unknowing investors lose their money. You can notify the SEC of any suspected securities fraud by using their tips, complaints, and referrals portal. If eligible, you can also apply for whistleblower status and earn additional protections and confidential guarantees. Pause. Also, if you suspect someone of this, they're also probably defrauding the Internal Revenue Service. You can also call the IRS and do a whistleblower. If you blow the whistle with the IRS and you can actually prove that they're defrauding people and they're also defrauding the Internal Revenue Service, the IRS will actually give you a reward based upon the earnings, the money received through the Internal Revenue Service. Let's continue. So the bottom line is, from helping you save for retirement, managing a complex investment strategy, a financial advisor can make your financial life much easier. That being said, there are quite a few factors to keep in mind when you're trying to find the best one for you. Make sure you do your research by looking closely at their credentials and other record with the securities regulators. Additionally, ask plenty of questions about their methods and how they're compensated. While there are rules stating that advisors should put your interests ahead of their own, this isn't always the case. It's a good idea to meet with a few advisors before settling. New content. And as always, share. Lastly, you can contribute to channel growth by donating. You can schedule a one-on-one appointment with a licensed financial professional, Or you can purchase insurance directly up to $1 million with an instant decision and no medical exam. The links are in the description. With that being said, wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. And remember, when people challenge you, they don't challenge you to challenge you. They challenge you to challenge you. Accept the challenge. Salute. Interested in having an evaluation? Find my contact info in the description and schedule a consult to explore your options. Have a financial question but don't know who to ask? Email me at a.hall@cgwealth.financial and your question may be answered in my next video. Security products are subject to investment risks, including possible loss of principal. Before investing, carefully consider the investment objectives, risks, limitations, charges, and expenses of the product and any underlying investment options. This information can be found in the product and investment option prospectuses. Copies are available from your registered representative.